Okay, everybody, this is Brant from tradeguild.blogspot.com, and I am finally back from my trip to Budapest and Prague. And I want to thank David from tradingtowin.blogspot.com for the fantastic job he did taking over and keeping the blog up and running and the tag board, which is a continuous problem for us. So we did a great job, and I thank him for that. So today was a pretty rough day in the market, and actually David requested a video about risk management or position sizing. I'm quite sure he doesn't need it. I think it was just in jest, but it is a good point to cover, a good topic to cover. So we're going to spend a little time tonight on that. So I've got a little PowerPoint presentation here. I hope it works right. It's my first time doing it. Oh, let's go back. Okay, so it's position sizing, and let's move forward here. Never risk more than 2% of your portfolio on any one trade. Okay, so I have an example down here. A $10,000 portfolio would tolerate $200 of risk per position. So we have 10,000 times 2% here, which gives us $200. Okay. Moving along, consider your risk first. When people look at stocks, they generally immediately go for the reward. They want to know how much money they're going to make. But really, the first thing you should look at is your risk and determine your stop. Okay, then you can look at the potential profit and evaluate the risk-reward ratio. And we're going to cover that next. And here we go, risk reward. All right, for me, I like at least 3-to-1 as a minimum. If I'm trying to decide what trade I'm going to take, I'm generally going to take the one that, number one, I think has the highest probability, and number two, has the best risk reward ratio. Sometimes 6-to-1, sometimes 7-to-1. The closer your entry to your stop, the better your risk reward relationship. So if you can wait for that pullback, you can actually afford to get a bigger position. So if we're looking at $2 reward versus 50 cents risk, that gives us a 4-to-1 ratio. If we're looking at $2 reward versus 25 cents risk at that 2%, that would give us an 8-to-1 ratio. So we can actually buy a bigger position with less risk. So let's move along and see what that looks like. So here we go with determining your position size. So if we have that $10,000 account as an example, and we've determined that our entry is 50 cents away from our potential stop, or where we would stop out initially, then we can possibly have a position as large as 400 shares. 2% risk of $10,000, which is your portfolio, equals $200 over here. And we've determined that we have a 50 cent, our stop is 50 cents away. So 50 cents into that 200 gives us 400 shares. If our stop is $1 away, then our potential position could be 200 shares. So we have $200 of potential risk per position. At $1 risk on that trade gives us 200 shares. If you're not following along here, I know I'm kind of going through this fast, you can just hit the pause button and take a look at it. Let me clear the screen for you. This last example, of course, would not be a good risk-reward relationship with $1 reward and $1 risk. I would never, ever touch a position like that. Next, determine how much of your portfolio you will allocate to any one position. For me, I like 4 to 5 positions maximum. I don't want too much diversification because it dilutes your winners. I think you can be diversified, staying in different industry groups or sectors. You can also diversify a little bit with your long-short exposure. If the market is heading up, we're in a nice bull market, and you have, say, 5 positions, maybe 4 of them would be long, and maybe you have 1 short in a really nasty, ugly looking stock that's just not doing well. And the reverse might be true. for a bear market. Maybe you have 3 or 4 shorts and maybe 1 or 2 longs. But what you need to do is make sure that any one position isn't overly exposed. In other words, if you have a $10,000 portfolio and you have $200 of risk, that's your 2% that we see over here. If you have actual 20%, if you're, or I'm sorry, 20 cents, if your stop is 20 cents away from your entry, and that would give you a potential of 1,000 shares on a $10 stock. So 1,000 shares on $10 is $10,000. That's your entire portfolio. So we don't want to do that. We want to make sure, we divide that up and don't take on too many shares. Because if maybe your stop is 2 cents away, that doesn't mean you should go out and buy 20,000 shares. Okay, let's move along to the next point. Adjust your risk to market or performance conditions. And what that means is, if it's a choppy market, it's going sideways, maybe you don't want to have 2% risk. Maybe 1% risk is a better way to deal with that, or you partially in cash until the market starts resolving to the upside or to the downside, and then you can jump in at that 2% risk. Another time I would drop my risk down to 1% or sometimes even less is if I'm in a funk or a losing streak. You want to reduce your risk until you get back into the swing of things, until you get back in gear with the market. At that point, you can go ahead and take those bigger positions, but when you are not in gear, it's either good to stop trading or dramatically reduce your risk. And finally, honor your stops. This is a point I think that really drives it home. A loss of 50% on a position, if you have a $10 stock that goes to 5, that rule will require a 100% gain just to get back to break even. You'd have to take that $5 and double it just to get back to where you started. So don't let a trade become an investment. Don't fool yourself. Assess regularly if your money is in the best place. Maybe your money is better served somewhere else, in another stock, or maybe it's better served in cash. But I would regularly check to see if you are positioned the best you can be. You don't want to just jump from stock to stock, but if you are in a stock that's going sideways and it's not doing anything, maybe it's time to move into something else. Excuse me while I get some water. And one question I like to ask myself is, if I have a position and I'm kind of hemming and hawing about it, I look at it this way. Would I enter that position right now if I was in cash? If not, maybe you shouldn't be in that position. So finally, I'm just going to do a real quick example here. I have LTRX up, and this was a stock that was brought to the Trade Guild tag board by KJ, and I featured it the last couple of days, Monday and Tuesday, and it was a great time to get into this stock. It was up a good 5.39% today, as the market was not looking so great. So let's take a look real quick. A little example. Actually, let me zoom in a bit so we can see it a little. No, I'll come back out. Okay, let's say our potential entry is down here at $1.55, our potential stop. And our potential entry would be right in here at $1.65. Our potential reward might be this first zone of resistance at $2. So what that means is we have 10 cents of risk on the downside, and we have 35 cents of potential profit, which gives us a 3.5 to 1 ratio, if that makes any sense there. So this would be a favorable trade, I think. If we have a $10,000 portfolio and we have 10 cents risk, obviously we could take on a huge position. We don't want to do that. We want to at least keep it down to maybe 25 or 30% of that portfolio. And that will do it for tonight. If you have any comments or questions, catch us over at the tag board, or you can shoot me an email. I have that up on the tag board regularly. Thanks for listening, and good night.